Let's start. You can begin.
Okay. Hi, everybody. Welcome. And we are going to discover a few or go over a few topics tonight. And as I'm waiting for any more to join, I'm just kind of briefly touching on
has joined the
futures.
meeting.
Just starting a brief while we're waiting,
discussing.
Hi. Hello?
Hello, guys. This is Manish.
Yeah. Hi there.
Manish
Welcome. Hi. Welcome.
Elijah already.
Okay.
Hey, Sandeep.
Okay.
Oh.
Mm-hmm.
Hey, I think as people join, just let them know that they can put themselves on mute so while you're talking. And
Okay.
Okay.
Okay, perfect. All right, I'll do that if I see people on. Okay, perfect. So basically, we're going to just start while I'm waiting, futures was not the discussion for tonight, but I just figured, while we're talking about it, particularly talking about downside, how to capture downside. And if you have a long portfolio, a lot of times things happen at night and you're just kind of like sitting idle watching your money burn away. So futures gives you a way to get in and hedge your portfolio by creating the opposite direction, whether you're short or long. If you're overly short and the market starts shooting up, this is a way to add long deltas or short deltas. So basically, futures just gives you that opportunity. And as I was discussing, there's different types of, you can trade the Dow futures, you can trade the NASDAQ futures, the small cap futures. So each one has their own index. And so basically, I'm going to pull this screen here. So I kind of look at, this is over here, the S&P futures, NASDAQ, the small caps, and then the Dow futures. So I kind of watch all of them here on a separate screen, and I'm watching, and I'm seeing which one is outperforming, which one is lagging. Right now, they're all like nicely kind of working their way up, which is great. So basically, a futures contract just gives you a way to trade a direction in the index that you want. So if you're bullish, you can buy it. If you're bearish, you can sell it. So you had the regular contracts, which we've been trading, or I've been trading. So basically, for example, this is the NASDAQ futures, and each point up or down is $5. So right now, as it's kind of going up, if I were to just choose to go long here, each point up per contract, if you see at the bottom, is $5. And then the margin required to trade it is about $8,400. So you can pick a direction, and you either go long or you go short, and then, basically you trade it just like a stock. You buy where you want, sell where you want, put your stops under it. So, and then so this was the regular futures, NASDAQ, for example. And then you have the micro futures, which just came out the other day, which I've just kind of threw one trade up here just so that, you guys can see one live. So basically this is a lot better and easier to play with because it's less money. And so basically each tick is $1.25 per contract. You can do as many as you want. You can do 5, you can do 10, you can do 1 for playing. And then your margin is about $700, which is, a lot less. So you can play with these, and it's easier on these if you're wrong to just take the loss or to basically flip it or whatever you want to do. So sometimes, I'll have one index that I'm going to take long, and then if I see a weaker index, I might short that one. But right now they're all pretty strong. So I'm just kind of like watching this to see, try to pick up a few dollars just for fun. And right now down here on the left, I have the futures where it's saying the Dow futures are up 16, S&P futures are up 1. So anyway, futures just give you a way to trade a direction that you want. And you can participate at night. It's open all night, and things happen at night. And, it's it gets active sometimes. Here I have on the bottom right lately the Shanghai Composite, just watching that because, trying to see is that balance, is that declining, or just kind of that may have some effect. And I'm also going to start looking at some currencies and see any correlations on those. I haven't done that yet, but eventually I want to look into currencies and see any correlations as another thing to look at. So anyway, futures gives you the chance to trade direction, and also the bigger topic today is to hedge. So basically, you want to hedge. This is a great way to put a position on long or short, And now with these micros, it makes it so much easier because you're not risking a lot of money. You're not, and you can just play with a few contracts and just see. And it's nice, like when it starts moving up in your direction, you could start putting stops under it. Like here, for example, I could just put my stop here, and then all of a sudden I've got a stop loss there if I want, or I can just continue to let it ride up and then just kind of, I'm waiting for it to kind of get up here, then I'm going to start putting stops under it. So anyways, this is just a way to trade, and it's a great way to practice before you trade the bigger contracts, because once you get a good sense of these, it's really a lot of opportunity. And this goes on all day. Like all day, I'm constantly trading futures in between. Like today was a down day. As a hedge, if nothing else, I was looking for shorting opportunities, picking some points up, and then getting out of the way. So anyway, this is futures, one of the hedging options that you have available to trade. So I'm going to go away from futures and now go back and talk about kind of the topics we want to talk about, which is portfolio protection, downside. So very briefly, just kind of want to look at what is a put. A put is basically insurance, or it's a bet that downward bet. So if I look at the spiders, the S&P 500 ETF, it's around 288. If I wanted to insure my portfolio or my SPY position, then I could simply buy a put. It's 288. I look at the strike. So I could I could do one kind of at the money, and basically around $338 is what it costs at a close to get protection to the downside. So that's for every 100 shares. So I could pay $338 roughly and get protection downwards. If it goes up, I'm good. I lose some premium as it's going up, but that's the price you pay for insurance. So basically, it's like an insurance policy. Just like you have insurance for your house, people buy insurance for their stocks, and put market is where you would buy that insurance, and puts is what you buy. You just simply go long the put or buy the put, and just simply buy it at the price you want, and then you can offer out or whatever you want for it. And I'm going to get into a little spreads in a few minutes, but basically, put is just a short term or a bet for the time frame. This was a May put that's expiring in 10 days. And then, you could go out a little further, and let's say June. Naturally, the further it is, the more you're going to pay. So you see that's for that at the money is about $642. So now you will notice that obviously puts are expensive right now. And why are they expensive? Because volatility is high. That's the key thing about puts. You want to buy them when they're cheaper, but sometimes you're forced to buy them when they're expensive. So we're going to talk about ways to offset that. But anyway, you can see right now, this is the UVXY, the short-term futures ETF. We're at a high point. Volatility has jacked up quite a bit, over 20, 30%. And that's causing puts to get expensive because whoever's selling these puts also wants to get paid for their risk they're taking. So there's two sides of this equation. You could be the one buying the put, or you could be the one selling this put. The one who's selling this put to you is basically saying that I believe that S&P is going to be above this price in June, and I want to capture this premium. So they're actually has $650 roughly of protection on their end. So 288 minus 650, they're kind of okay till down here. That's when they get in trouble. So basically, you can sell a put or you can buy a put. Now, I don't encourage going out and just selling naked puts and things like that for new people unless you know what you're doing. Right now, we're focusing on just protection, and basically, we're looking at longs as buying puts. So basically, you buy a put, you can choose if you want to go out of the money, if you want to go in the money more, whichever way. In the money would be up higher in the put side, and out of the money would be lower. They'll get cheaper. So let's say you want put protection under 280 for June, then you would pay $400 roughly, and you're protected under 280 minus your premium cost that you paid. So anyways, puts are short-term bets, good hedging mechanisms, but the key is that when volatility gets high, they get expensive. So sometimes people buy them when volatility is low, which I know Thiru, thankfully has been buying some, which was smart and when they were lower. And then now those things are worth much more money, and he could sell them or he could hold them, whatever he wants to do. And so basically now the question is, when volatility gets high and you have to pay a lot for these puts, what do you do? How do you offset that? So basically, instead of just buying a put, I would say, buy put spreads. So you could either simply buy a put. I just buy it. I could buy one, just put right here, 288, and pay $645. So that's a lot of money. And I don't really need protection from 288 all the way to zero because it's unlikely to go to zero. So I always believe in just doing spreads. So I would buy a 288, and I might sell one lower. So let's go to a chart and look at it. Let's look at the SPY. So this is where, a little bit of technical analysis comes in. I could look and say, well, this was support down here at 280. This was previous resistance that became support. So maybe if this market falls, it's going to go to 280, maybe 275. Let's see. Manish is asking, what happened to that question? Sorry, how do I find that question again? Let me see.
He's asking, what is your strategy in selecting particular contract? Do you look at delta, check trend based on EMA or support?
Okay.
Yeah, this is Manish. Yeah,
hey,
I think somebody explained it. Yeah.
Hey, Manish. Okay, go ahead.
Yeah, that's a question. That when you are selecting particular put, then how do you go about selecting it first? If you take the example of your NDX or another one that you were showing, something you were showing just before, some MES or something. Okay. So how do you go about picking? Okay, I should pick June 12 call, put, or maybe July. Do you look at the delta, or what is it that you're checking?
Okay, sure. So, I mean, it does take a lot of personal preferences and experience. People do different things that work for them. I personally like to protect. My personal preference is kind of at the money because I want to protect from here below as far as the strike price, and I'm going to talk about expiration. I want to protect from here. I don't need to pay for a deep in the money put because that's already happened. I'm concerned from here to the future. So this is my personal thing. So, naturally the delta is around 50, for the put. But naturally, as it drops under that, this delta is going to increase and become closer to 1 the further it drops. So my opinion is that I buy at the money instead of buying deep, and paying all this money for things that have already happened. This is already done. I don't need to pay for this. So I want to pay from here. I want to pay for something here downwards, or I might go a little lower even, just so I don't overpay. I might go to 285 and have 3 points of potential loss before my protection kicks in. So I usually go at the money or slightly out of the money just because I don't want to overpay. And then I'm going to talk about offsetting it with a spread. So, and again, you can also come down to charts and things like that. Kind of look at your, what's going on, and what do you feel that it's going to drop, how much, and how much are you fearing? It depends on your position sizing. If you have a lot of stock, then you want to, basically protect more. So it depends on if you're using it as a hedge against your portfolio. The more stock you have, the more negative delta you want to offset that. Let's just say you have a delta of 1,000, then you want to kind of offset that maybe with 500. So it kind of depends on your portfolio, how much, and then what strike. But like I said, I personally prefer, and Thiru may have something else that he prefers, and I'm going to let him talk a little bit in a couple minutes. But I prefer at the money, and then for the month, again, it's kind of the outlook. The further you go, the more you have to pay, but at the same time, the longer protection you have. So right now it would not be point really just to buy May expiring in 10 days because that's not much time. Assume that we have a sell-off. Maybe we have a sell-off in the summer or sell in May and go away kind of thing. So we kind of want to, sorry, dang, something just sold. Okay, cool. All right. Okay, cool. So anyways, so we want to make sure that we have protection for a little while. So you could do July, which would be fine, and some people go even longer. Sorry, go ahead. Mm-hmm.
Yeah, that's for the hedging, right? You are buying the put. So if we and what about when you are selling it? Selling also.
Okay.
Selling you must not be doing for ATM, right?
So what was the last thing you said? Selling what?
Selling, are you doing at the ATM or selling would be different, right? If you want to sell the
selling, I would be more cautious because I wouldn't be selling at the money because if you're in a downtrend, you're going to get hit. So I go to my chart and look at levels. So here, like today, I started selling 280 put spreads. So 280, I feel like if this market falls, which it could, 280 hopefully will become a bounce point, and then 275 is the next level. So 280, I think that I would expect buyers to come in there if we go that low, and then basically that's where I would be selling puts. For my preference is to sell them at support levels because maybe at that point I want to buy the S&P at 280 and I don't mind being put it if I want. But I don't always do that, but just saying like that's one thing I just kind of keep in mind, like where would I buy it? I would consider buying it at 280, so then I'll sell a put if I want to. And then as far as the months, like I said, you can go out a month or 2 months, for buying it. Okay?
Yeah, get it.
Okay.
Yeah.
Perfect. So back to the spreads. Sorry, I just want to do one thing real quick. Oh, nice. Okay, so now I'm just getting back to my future example. So now as it's going in my direction, I'm going to start putting stops under it just to kind of like lock in profits as it goes up. So I set a stop right here. So I have 3 contracts left here. If this blinks under this and this one gets taken out, and I'm just kind of having some higher limit ones just for fun. But this is just an exercise on trading futures. So I just kind of want to lock in another contract here to lock in the profits, and then I'm going to just leave it. Okay, so back to the. Okay, so now talking about spreads. So if instead of just paying $642, I want to offset some of that. So what I do is I buy a vertical. Basically, I buy a 288, and then where that support point was, I would sell this put. Okay, so basically I'm buying the 288, and I would sell this under it. And now look, I'm only paying $233. Now, true, I have protection from 88 to 80, but I'm paying much less money. So you could do more of these perhaps for the, and instead of just buying $650 for one, you could do more of these, and you could do 4 of these and get nice protection down to 280 and actually amplify your returns as it's going down because you have more in that range where it's possibly to go. So anyways, does everyone understand like how to put spreads, or do you want me to explain it more?
Yeah, no. Yeah, definitely.
Everyone understands, right? Okay.
Yeah.
So yeah, you're buying one, you're selling one under it, and that makes it a spread, and it makes it less money. And that's a great way to protect but you don't need always protection to 0 because the thing is not going to go to 0. Even if you want to go all the way down like 255, still something to offset, the cost. You don't want to pay the 642. You want to offset it somehow. You in the next month, it's possible, but it's not likely that it's going to go below 255, right? So you don't need protection all the way down 0, in my opinion. You just need protection to a level that, like maybe 260, just to, if you think really things are about to fall apart, you could just do that. So anyway, put spreads.
So on the vertical put spread, how do you pick the strike price?
So you pick, like I said, for me, I prefer kind of at the money for the top one, or a little bit below if you don't want to overpay. Because I want to start being protected pretty soon from the price it's at. If it's falling, that's the whole point of insurance. Is I want that insurance to kick in with little deductible as possible. So I want to start kicking, or you could do 287, just a point lower, just so you can reduce your cost. So you could do 287 and down to where the support level is 280. Okay, so the stop got hit on the futures. Okay, 272, 280. and it would be a little less money. It would be $197, which is, a lot better. And you get protection, 7 points minus what you pay. So you get 500 roughly of profit if it breaks through that bottom strike. So, like I said, I personally pick at the money or a little bit under the money, and then I'll sell one under it. So what you're doing is you're buying this insurance, and then you're selling, some under it that, here, because I don't need it all the way to zero or whatever. This, you can pick 275, whatever. The lower the bottom strike is, the more you pay, but the more protection you get. If really things are looking bad, this is not a bad one, 287 to 275. That way you get protection all the way down to 275 here. It gives you all that gap of protection for not a lot of money. And that's why I would say you definitely, when volatility is high, I would suggest doing put spreads, buying put spreads for protection or downside profiting. But if volatility is low, like probably this was a lot cheaper last week when, S&P was over 290 and volatility was low, it might have been like 500 or 400, then maybe you could buy it outright. But I still prefer to do spreads just to save the money and also kind of based on where I think it's going. Unless we're in a horrible market, then you just buy the put and make money and then just ride that thing. It doesn't matter what it costs. If the thing is falling apart, this 642 will double pretty soon if the markets are just collapsing. So it depends on the market as well. Okay? Any questions on spreads? Basically how to do a spread?
Thanks.
Okay, cool. So I'm going to be talking about now, I like to be savvy. I like to have other people pay for my stuff. So what I like to do is when I'm buying a put or a put spread, I still want somebody else to pay for it, So basically what I do is I sell call spreads to pay for my put spreads as much as possible. So we're talking about all the things you want to do to maximize the downside. 1 is buying puts, 2 is buying put spreads, and 3 is selling call spreads. Like that's what I've been doing lately because I kind of felt like, naturally when we were shooting up, it's like, okay, there's gonna be some pullback at some point. And so what I started doing recently was like I started unloading my stocks and moving over to long options just so I'm still involved, but with less money and my capital is not at risk as much. Of course, the long calls cost money, but, it's fine. So what I started doing is I started selling call spreads up here. Like as soon as we were going up here, getting, extended, I was like, okay, well, we're going to get a pullback at some point. So 300 and above, I started selling call spreads, and I did that for all of them, like QQQ. I looked for like a high level up here, started selling, because the higher it goes, the more expensive those calls get, and the more money you get. So you want to, it's kind of counterintuitive, but when it's going up, that's kind of when you got to sell the call spreads because they're more juicy. And then you're going to get some pullbacks at some point. The market can go up, and it did, but even no matter what, it's always going to give these give backs. So you kind of wait for it to get extended away from the moving averages, and then you're going to get a pullback, extended away from the moving average, pullback. So you kind of want to wait for those. But anyways, you could or should consider selling. So if and when we make another leg higher, again, I'm going to be selling call spreads because I know that we're going to get a pullback at some point. Some news or something's going to happen. So, and usually sometimes I'll go pretty far out on those because they're more juicy. So, like for example, July, 300, if I sell it, now there's 2 ways to do it. If you own spiders and you want to just sell a covered call, you could just simply sell the 300 call, get $230, and your stock gets taken away at 300. Or you can do it naked, but I'm not suggesting that. So what you want to do is if you don't own the stock and you're kind of getting ready, you're like, okay, I think the markets might pull back, yada, yada, yada. What am I going to do? So then you can start selling spreads. The same thing you do it like this. I would sell a 300. Now, it's not as juicy today as it will be when the markets go. I wouldn't do it today. I was doing it today anyway because I just saw the market collapsing. But just the fact that, you want to do it when it's going up higher. So you'll get this. This was like $300, earlier when the markets were going higher. So now it's dropped to 233. So I was able to buy these back at 233. But anyway, they were 300 or so before. So whatever. So anyway, you would sell a vertical call spread. So what you're doing is you are selling the first one, and then you're buying something above it to protect it from, in case the market does shoot up. So let's say 300, 310. So let me see if it'll show an analyzed screening. This is well, I'd have to get rid of my other position to show. But anyways, so basically, like I said, you let me see if I can analyze trade. Okay, so what happens here, this is what's called a risk profile. And it's really nice to look at because this shows you, right now S&P is right here at this point, 288. If it stays anything below this level by that expiration, this down $187 is mine at expiration. When I get in trouble is when it starts getting over this point, my break-even point, about 301.87, which is what I paid for it. Then, I can start losing money. But my max loss is the difference, which will be $813 is my max loss. If this market just shoots up and goes up there at expiration, I would lose this. If it never makes it there, I keep this. But every day as it goes closer and closer, the theta is burning. Right here's theta is burning every day. So naturally, if it just kind of stays here for a while, this theta is increasing. I make money. I could wait for just one big down day and just take a good portion profits off. That's what I did recently. I waited for a good drop and started taking it off because I already got my profit, so that's good. Now I'll do it again when the market picks up. So anyway, selling call spreads is a great idea, and of course you can do it on stocks that you own. You can sell covered calls on stocks that you own, or you can do it on the indexes if you have a long portfolio and you're getting very long. This is a good way to bring some negative delta into it. This was negative 17 delta, and this is for one spread. So basically this is your delta. If your delta is really big and you want to kind of bring it down some, this is a good way to bring negative delta. And the same thing when you're buying those put spreads is you want to get that negative delta to kind of make your portfolio more neutral. So again, like I said, what I like to do is, like, for example, sell the spread, and then let's say I'm going to use that to buy myself some protection for, like, let's say June. So what I would do is I would take credit, and then I would buy myself that. I'll probably do a 287, 280. So I don't know. See if they'll let me put on the same screen. It's really weird. I think I have to hold control.
Yeah.
Anyway, then yeah, I would take that money. I'm using the proceeds to buy the put spread I want, because you have to be savvy. If there's money out there, you have to take it. And so, like, basically, from what I got from there, 187. This is 197. I could do the whole structure for very little, like 10 cents roughly. Of course, it'll change in the day, but just saying, this is a good way. Sell a call spread, use the proceeds to buy a put spread, and then you don't have to pay a lot of money for protection. You could do even more than then you might want to protect a little more because you're getting some help, and you could do like a 287 and this spread right here, which will give you a lot of protection for $300. You take in about 190, you pay $100 for this structure, and you get good protection, and somebody else pays for it. You get it?
So Sandeep, Sandeep, I get it. This Manish here. So you mentioned you sell call spreads when the stock price or futures, they are going up. That's when, like,
right.
You start selling the mono call spreads, right?
Yep.
Yeah.
Yep.
Okay.
Because you want to capture.
I did hear you talk. Yeah. Generally,
right.
like, I personally do a lot of spreads. I also like to use put spreads. I sell, I buy. So I keep it delta neutral. Like, I go by, my bargain is 25, minus 0.25. That's where, like, I put my buy for the put spread, and also for the call spreads I do. But I'm just trying to understand one thing. So call spread, you buy, let's say right now the market is going down. So will you buy call spread now, or will you wait for the market to turn around and then you will start buying? Let's take example of Microsoft. I own the shares, so I want to protect that, right? So I was thinking today of, okay, I should make maybe put a put spread or something. I should do. I was coming down almost to below 112 based on the delta, which was 0.30 something. That I will sell the put spread there. Maybe it will not come down below that. And then I was thinking.
Okay.
So now in this situation, what would you do? What would you do when you know this? Okay, Microsoft is coming down. Even the market is coming down. You looked at the indexes. Then what? What would be your approach?
Yeah, I mean, if you have a lot of stock and you want to protect it, then the same thing. You basically would just want to buy a put spread to where you think it might fall. So like I said again, I wouldn't just buy a put because, and a lot of people just buy far out puts. Like were you saying you might buy a put down here, like 112 or something?
Actually, I was thinking both ways. Like you see, I am looking at it right now. I'm looking at the delta. My delta is showing on my my this trading platform. I'm looking at all the option chains, and I was thinking that I will sell on the top support level is at 128. So I was thinking 129 and 130. That's what I was thinking. And they're
selling
actually,
a spread.
I will, yeah, sell, and then below I will go below 112 to
sell
offset that.
To sell a spread.
Yeah.
So you're selling a call spread and selling a put spread, right? Correct?
Yes. I mean, that's what actually I was thinking. I was not thinking of buying it.
Okay, so yeah, you're not necessarily you're not protecting your portfolio this way. You're just trying to capture the data, I guess, if it stays in that range and make money, which is fine. It's great, because you're selling here, and it may stay here, and that's a great strategy. It's Iron Condor. I'm sure you know that. So
yes.
That's one way to kind of just capture premium while you're waiting for the stock to do what it does, which is fine. It's fair.
Mm-hmm.
Now, it's not really protecting it so much because, if it falls down below, you can get hit. If it, I don't think it'll do that, but if it were to, you still, you have losses down there and you're still losing on your stock. You're not protecting. If this thing starts falling, you're still losing money in your stock, right? So that little bit of change is not going to really.
I'm losing, exactly. Stock I'm losing, but I made some money, by selling at 128 and 132. And because this interesting that you mentioned that you start selling the call spreads so soon, that actually that never struck to me that okay, I should be doing that. I react only when the lines, for example, I have 4 different EMA lines. I have 5 EMA, 20 EMA, 40 EMA, and 120 EMA. So I chalk out if 40 EMA crosses 120, below 120, then I start reacting.
Sure.
So mine is more reactionary, and it seems like you are now. I'm writing it down that what you're suggesting is very different. That's a proactive approach.
Okay, perfect. Yeah, perfect. Yeah, the key is you don't have to wait for the collapse to start selling call spreads. Find points that are higher up, and you can use Fibonacci or different things, but you can look at long term. Right now Microsoft, you see, it's in this channel, but usually when it gets to the top of a channel, is actually a point of return, right? So exactly what happened is when when it went to the top of the channel for the long term, that's the point kind of to start selling call spreads. You have to be proactive, forward thinking. That's the key in this game. Is basically this thing is extended, is gone above, and then usually when you get these are gaps. Whenever you get these gaps, this is the earnings gap. A lot of times gaps get filled. It just does it. I don't know why. It goes up, it'll play around, then whether it's the market correction or whatever, it will kind of, it likes to back and fill. Just the way it is. So that's the kind of the point when they pop up on earnings, volatility is high. That's kind of what you got to do. And I did exactly that for Facebook. Facebook was great because when this happened right here, boom, I was like, perfect. It's shot up high. It's kind of extended. It's going to back and fill some. So I started selling. I've got a lot of short call spreads up here because I was like, this thing is going to pause. Of course, it could have kept shooting up, But the reality is that, the volatility is high. It's going to recede some. It's going to pause, catch its breath. So that's exactly what happens. That's the time when you want to sell call spreads, when you get these pops.
So you are saying like, so we checked that, okay, I checked that the volatility is high. That's one.
Right.
And plus, like, okay, there is a gap because earning event happened or something. And then based on, like, okay, this, you are right now drawing these lines, like, some your diagonal support lines.
Yeah.
And then based
channels,
on that, you see, okay, you channels, and then you do far out, you will short far out call spreads, right? You will start selling.
I'll sell my,
right?
Yeah, and I'll even sell them out like several months. I don't need to sell this week or next week. I want to get more money. So I'll sell like June, for me personally. Like I'll even sell like June and stuff, because as it's pausing, that even that's going to start making money. Like I started selling June 200 and 210. They were much more money then. And now they've come down. Now you still get like $218, which is not bad, but back then they were $300. So when it got that pop, so already 300 to 220, that's already a nice profit, right? So yeah, you want to, and I don't mind going further out. I even sell January just because I know there's going to be some pullbacks. I'll find I've got January Facebook one sold right here, 220, 225 already, and then they were like 200 something back then, or whatever. Maybe they were 200, I forget. But anyway, they're 125 now. So I don't mind going further out and just selling them. I have nothing to lose, because I can always offset that if it starts getting threatened or something. No problem. I get them from the other side. I've got put spreads down here already on Facebook, for example, 155, 145, all these to offset this. So between now and January, I expect Facebook to be hopefully over 155 and under 220. So I just kind of leave it, right? And that's kind of what you're doing. You're selling a spread and up there. But some people are scared to go far out. I like to go far out, me personally, because I get more money.
That's interesting. Like, but question is like, you went far out. So then, okay, you got the initial credit, but then you have to wait until that expires, or unless that stock completely reverses and you get some in the money, right? Right now the example that you were showing, that 218 initially got the credit, but again that is not all in the money, right? Until you have either it expired or something happened that stock completely reversed, right?
Sure, but I'm not looking for the full. I'm not looking to make the full profit. I'm looking to make 10 to 20%.
Okay. Okay, got it.
So, So it's not about waiting for it. As soon as I get 10, 20%, boom, I'm done. I'm not gonna try to be greedy. I'm like, move on. I've got my profit. So already I've gotten more than 20% in let's say a few weeks. And thankfully they did pull back. The markets pull back. So. And I'm doing the same thing now on the put side. Now that it's falling down, I'm starting to sell more put spreads down here, because I'm like, well, this is good. Volatility is higher. These puts are, hopefully going to be fine. So I'm selling. When it's going down, I'm selling put spreads. When it's going up, I'm selling call spreads to get more money. That's the key.
So like
when it's going up,
check volatility. Okay. So for volatility, generally, you check like VIX, it starts moving, and then that's when generally I check VIX 40, 45 like that. But okay, it is high. But generally, just like for example today, how do you really measure that? Okay, volatility is high, then that premium on these calls will go up.
Sure. So let me see if I can show you. And this is I don't know if do you have Thinkorswim or no? Do you use another platform?
I have something similar.
Okay, sure.
I have T-Trade level 2, in level 2, and plus I have another one, so I can see at least the orders coming in quick.
Okay. See, I have on my chart, I have a study for implied volatility, and basically it tells me the percentage. And here I say So here, so I look at the general volatility. Yes, absolutely. I look at the volatility of the market. So I'm looking at the UVXY, and I'll just go with this real quick volatility product So I look at the UVXY, I look at the VXN, which is the volatility of the NASDAQ. I look at the RVX, which is the volatility of the small caps. And then I've started looking at TVIX, which is like another volatility. And there's a few others. But anyway, I look at the general volatility. I'll look at the chart of the general volatility. CIV, I think. And then this is the inverse volatility. And then there's VXXN, I think, or VXXB. Oh, maybe they changed it, but whatever. Anyway, so I look at the general volatility to give me an idea. And of course, the market's going to tell you when it's falling that the volatility is high. But in addition to that, I look at the implied volatility of a stock. Certain ones that either fall. Anyone you can think of that fell hard today? Was there anything that would have a high implied volatility? If you guys think of one, let me know.
NVTR.
NVTR. NVTA, okay. Now that might have been
NVTA.
Okay. Yes. Okay.
Yeah,
I'm surprised. Okay, that's it, right? I'm surprised it's low, but maybe it's not the. Yeah, I don't know. I'm surprised it's so low, but anyway.
Baba.
Yeah, Baba was probably higher because of the China stuff. So yeah. So okay, perfect. So now look, this right here, it tells me the implied volatility, the rank, and everything. So anyway. This is it's been around 35 to 25, and all of a sudden, with the China stuff, it's ranked up to 44%. Naturally goes high during earnings, 62%. So anyways, I also look at this occasionally. I'm like, okay, volatility is jacked up on this stock. Great time for me to sell put spreads on this particular one because it's dropping. So I look at the volatility of the stock also, which is available for any stock. And this, I don't know, if they have it on your platform, but anyway, but if you ever want me to look at one, just let me know. Like if you ever see one that you want me to check the volatility, just let me know. I'll put it in the group. But anyway, this is where it's charted. So yeah, when it goes higher, that's when we want to sell premium. When it's lower, that's when maybe we want to buy premium. That's maybe we want to buy calls or whatever, But when it's higher, we want to be definitely looking to sell, and always before earnings. You're going to get those spikes. CMG was a good one. That had a nice spike before earnings, and then it's petering off now. So we want to definitely take advantage of the high volatility in our favor.
So when volatility was high, then you sold the put spreads, right? And did you look at the delta that where you should be selling the put spreads?
For me, to be honest, I don't look at the delta. I could and should. I just look at the charts. For me, I look at support and resistance, and that's pretty much going to tell you the delta and everything. But anyway, I look at support and resistance more than anything. And some people do it by delta, and that's perfectly fine and great. It's good. To look at the delta.
Yeah, personally, I do. Yeah, personally,
I
do.
Great.
No, I don't cross 30. I like 30%. I keep it 30%. That's like a very, very, very conservative approach. That's what I like to take.
Sure.
So
let's just say let's look at BABA and 30%. Let's just say June, for example. It would be around 170, right? So ironically, that's probably a support level, right here. So I would, which is fair. Like that's a good safe place to do it. 30% chance of being in the money, or 30 delta, is a fair. Some people do 20, are very conservative, but 30 is a fair one, and that's a good way. That's a good way, I think, to do it. Absolutely, if that works for you, stick with it. Ironically, that's also the 100 moving average. It's below the support level, so that's a good safe place. I might be a little more aggressive and do it at 175, just because I see the support level, and I would expect a bounce there. So I might do 175, which will be a little more delta, 36. But but I don't go. I'm not bold where I do it up here. Well, actually, I am. Sorry, but but I won't teach that. So yeah, I would teach to do it in like safe areas like down here. And I'm bold when I'm being challenged on the other side. Like if I've sold 190 calls and they're starting to get challenged, then I inch my puts all the way up to here because I'm just trying to battle that. I'm trying to keep my delta from getting too negative or whatever. So that's just for my active trading. But for the people who are working and just set it and forget it, yeah, sell it at those 30 deltas or at support levels and leave it, and then do it on the other side too. I believe, don't just do it on one side. Wait for an up and do it on that side too, because you're always going to get a pullback. Except for okay. So
yeah, I get it.
Get it?
Yeah.
Yeah,
I get it. Like, then, I was writing my notes. Like, so you start with the volatility check. You check the stock's implied volatility, and when the stock is going up, that time you tend to sell the call spreads. They're like far out, right? Far out call spreads.
Yeah.
Then you
again
then
my preference.
Sell. Yeah, I get it. Like, this is different. Like, I'm understanding. And when the stock is now coming down and IV is high, that time you are selling the put spreads instead of you are not. Do you put bear call spreads and all that? Or no?
Well, it depends. Like intraday, I am because I see the garbage falling. So I'm like, you know what? If it's falling and I can take advantage and make some quick money selling calls, I was selling naked calls on Baba all day because I just knew that this thing was falling, and it was going toward 180 and so on. So I do intraday, I do it, but I'll clean them up by the end of the day or cover them up or whatever by the end of the day. But yeah, I do it even when it's falling. But for swing trading, I think it's better like as it's going up to do it there, when it's higher. If you're swing trading these, like I'm doing it intraday as well, because for me, it's like, for me, when the markets like today were falling, I was selling the hell out of calls because they were just collapsing. And I'm like, well, that's fine. If they're collapsing, I'll keep adding. I keep doing it until it doesn't work, because it's just money that's there. So, on intraday, I do it. But in the swing trading, I think it's better to do it when it's going up so you get more money, and give the time to work out. Good.
Yeah.
Okay.
Yeah. Okay. That's interesting.
So
That's interesting.
Okay.
So do you? So generally,
mm-hmm.
Do you do it on individual stocks or do you do it on all futures?
I do not. I don't do future. I don't do future options. I do SPY, QQQ, IWM. I do all those.
For index.
Because I do all the indexes because they're correlated, and when they're falling, they're all falling. So today I was selling calls up here all morning, and then I cleaned them up, and then on the same thing on the SPY, I was selling calls all morning up here, like 292. I was selling lots of them, and then same thing on the QQQ. I was selling up here, lots of them, and they were just collapsing nicely very quickly,
So if we come 20% on the same day, you close it. That's it. You clean them up, right?
Yeah, 10 to 20%. I'm done. Yeah, that's. I can't ask for more than that. Yeah, I don't like to be greedy and try to get to 100% or 50 because I'm like, if it gives it to me that fast, take it fast. You know how it goes. The next day it's gone. It's not guaranteed.
Yeah.
Unless you get a trending market, of course. Like you get trending market, then you get it. But still, this market is so crazy. You never know. Things change fast.
Yeah.
So
in your platform,
and
like
then,
this cross platform, how much do you pay for per trade of options?
50 cents per trade. 50 cents. 50 cents
50
per option.
cents, yeah. So, yeah, that's like my platform is charging me more. Like so, yeah. Okay.
It adds up. Yeah, it adds up if you're paying more. Yeah, that's why I have it low. So if I make $3-4, I still make money. On a just because I'm like, hey, $50 round trip. Not that I go for only $3-4. I try to make it more than that. But just saying, if I've got a few dollars and I just want to clean up and move on, then I just do it.
Yeah. Yes, indeed, get it. Yeah.
Good.
Okay.
Yep.
Yeah,
so,
I understood. Like that's interesting. Definitely, I learned a good strategy, to sell call spreads when it is going up and up. Yeah, so that's pretty good.
Yeah, a lot of people are afraid to, but that's when you kind of have. It's hard to, but it's kind of when you need to. Like Amazon was a little tough like I started selling, like it started shooting up, and I was selling calls up here, and they really started getting pressed last Friday when Buffett came out, and I was like, crap, all that, like over 2,000, I've got a lot of call spreads up here, and I was like, crap, but same time, thankfully it pulled back, and maybe I'm lucky, but at the same time, you kind of have to do it while it's going up, and then just wait, be patient, and I give myself time. I don't just sell the next. Now it's after earnings are done, then it's great because now I don't have to worry about earnings being in the way. That's the best time I love. After earnings, now I'm free. No big earning moves should happen. And usually if there's a shocking news, generally it's a downward, right? Generally if there's some shocking bad news, it's going to drop the stock. Very little news will take it up except for like, buyout or something like Buffett or something. But generally the risk is to the downside, right? In stocks, that if there's some bad news comes out, it's more likely if it's going to drop than pop, in the big stocks. So that's why I feel better. I've actually sold, even in this uptrending market this year, I was looking at my calls to puts ratio. I've sold much more calls than I have puts this year, even though puts probably would have worked out because it's going up, but they were not, volatility was so low, they were not giving any money. But I've made more money by selling calls because they've been juicy, and every time you get the give back, then it's nice, like Boeing has been a great one, like I've sold.
Yeah. And Boeing is one of Lockheed Martin, and some of these are aligned. These have been some of the stocks like where I have been constantly selling the put spreads, not like selling the call spreads, because that idea never occurred to me.
Yeah.
When I
So like Lockheed Martin, I don't know if you own the stock, but I would definitely be selling calls. Because it's you've got this it's pausing here. It's got this big cup. It may do this. I mean, it could keep going, but it's not. I don't think it's going to get taken over. So it's not like you've got a lot of room. So 350 is a high number, and then when we get a pullback in the market, this thing's going to pull back too, if and when we do. So and you still get good money. Wow, I would even go out to January and sell like a 370. No, what was the sorry? I would sell like 370 and up, and I'll probably do that tomorrow. Now that you reminded me. 370, yeah. So anyway, some spreads. I'll sell some spreads up there. Let it just sit there and do nothing. That's almost $200. Wow. So that's you could even be safer and do 3.9. What's the delta? And that delta is about 30. So yeah.
Yeah.
You could even be safer and do 390, 400. You get $100, and you might make 20% over time. That's great. But I would even be more aggressive and do 3, especially if you own the stock. Then you're a golden story. You probably get 200 on the next pop, and that's just money that you can keep, right? So don't be afraid to sell call spreads. Actually, more risk to the downside always than upside. Generally.
Yeah. Okay. Especially like with this low beta stocks, definitely these will not get taken over, and they move.
Yes.
They tend to move slowly up. Yeah, they have a nice pattern going up.
Yep. Yeah. Exactly. Like those, as well as big mega caps. Like it's not likely. Wow.
Yeah.
Sorry. Let's see these futures real quick. The mega caps are not going to get taken over. So see right here, this was the S&P future. So good. So yeah, I was just doing an example to show the micro futures. But yeah, it's like had 3, not a lot of money, but I was just doing it for fun, just while I have it on. So it's just nice to like just get some points, while you're sitting doing nothing. Now I'm just going to put a stop below it. The last one. No, I might leave that for tomorrow. It doesn't matter. Okay. So
one thing
anyway,
I have personally learned is I do only on this mega, but not the tech stocks. Generally, tech stocks not much, but like from energy sector, defense sector, they tend to move very slowly up and down. They don't just crash until some bad news like Boeing. Otherwise, my calls or like puts, whatever I have played on the spreads, they have always turned into green. I will say always, because 90% of the time. But Tesla has burned me always. Tesla, the stock has burned me. Everything. Tesla had been really
everybody. You're not the only one. Yeah. Yeah, stay away from Tesla. I tell everybody, do not trade Tesla because unless you know how to do it, it's going to screw you. It screwed me. That's how I learned how to trade it because it screwed me last 2 years ago. And then I was like, okay, I have to figure this thing out. It was like my revenge, you know. So, but yeah, you don't mess. So any other, you give me a lesson. Any other stocks to look at or any energy or anything we can look at? Any energy stocks?
That actually, I own some of the, like I own Schlumberger, SLB.
Yeah.
Schlumberger,
okay,
Schlumberger.
So,
that's like, it fell down. Like, that's like my bottom fishing stock. That one, Halliburton. These are some of the stocks I own. This one, in fact, actually, I'm in green, this because I bought very low.
Which one?
Schlumberger. Yeah, this one, SLB.
Yeah, sure.
SLB.
Yeah, perfect. So, and this is probably correlated to oil, right, or no? Is it correlated to oil?
It is, but not like, it's not like a very strong correlation, but yes, it has.
Okay.
Yeah.
Yeah, nice. So yeah, I mean that's good to you. You figured out what works for you and stick with those. Like, figure the stocks that work for you, just run with those, right? And that's the key. Like, just stick with what works for you.
SLB? Yeah, on SLB now, like, summer is coming, oil might be going up. So what would be the options, like, option trade for SLB?
I mean, you could sell put spreads, obviously, to because it's got a floor at 35. So you could sell put spreads, and I like to, if I'm bullish on something, I like to use those proceeds to buy my call spread. So I would sell put spreads or puts down here and use that money to buy call spreads. I always do that because I love for somebody else to pay for what I want. So I would just basically, and it may not get a lot of money, but let's just see, SLB, depends on how aggressive, let's just say in June, you could sell, you're not getting a lot of money for these, but anyway, let's just see 35.30 put spreads. You might get 30 cents, and you turn around and buy a 40, probably 40, 42 and a half. Yeah, you still have to pay some money, but, I like free trades, but that's fine. You could be a little more aggressive and do 40.35, and then use that money.
Are you selling?
I'm selling a put spread. But I'm
Okay.
buying a put spread this time. I'm buying a put spread. Because if I'm really bullish on something, I want my delta to be long, but I don't want to buy the stock. So I get positive delta by selling the short put spread and buying the long put spread, and hopefully one finances the other. So that way I don't have to pay out of pocket a lot of money. I do have margin risk a little bit on the downside, but so that's how I love. These are risk reversals. That's one of my favorite trades, is sell a put spread and use that money. So this is $1.31, and use that money to buy a call spread, $1.13. So this actually would give you a credit a little bit, and you get to be long if you believe in it. That is, and a nice time would be to put that on would be when if it drops a little more down here, then that's a good time to put it on, because you'll get more money for the premiums and the put calls will be cheaper. So yeah, right now if you feel like this is the bottom.
Yeah. So in this example, like just say for if you will sell the put spread maybe 36, or 36 and let's say 35, or maybe 37, 35. You sell in between there the put spread for June, and then you are buying call spread where you are buying.
Kind of at the money, kind of right here. I kind of go at the money because I don't want to pay for deep in the money. So I buy at the money is about 40, right?
Yeah, it's
40, and then I'll sell, and I sell a call above it because I don't want to. I could just buy a call if I want to. If I'm really bullish, I could just buy this call. Right here, $200. I get 130 from somebody else. Then I pay $70.
Today actually I bought call on this one and also Floor Engineering for October 2019. So FLR. That's actually on $30 for that and $40 for this one.
Okay. So, but you sold. You sold a put. What did you say? Sorry, you sold. Oh, you bought a call. Sorry, you bought a call.
Put spread. I put the put spread 25, 27 on the other one, 36 on this one, below that. And I bought call 40 on SLB and 30 October 2019 call, $30 on FLR, floor engineering. Floor.
Okay, got it. Okay, perfect. Yeah, so that's what you're doing it. Yeah, exactly. So same thing. I like to sell put spreads. I like to use that money to buy put spreads, so on and so on.
Mm-hmm.
Okay.
Interesting. Yeah,
cool. And I didn't want to get into it, but like, do you know how to do butterflies?
But I know, but I have not done it. I keep it to honestly spreads, condors, call sports. That's it. But I have level to trade pretty much everything.
Okay.
Yeah.
Because that's how a lot of times I buy my put protection, and I didn't want to confuse everybody. So anyway, a lot of times I'll use butterflies, and I'll just do one just to show. But I mean, this is just for anybody who gets it. So basically, like I like to buy my put protection even cheaper. So let me get spiders here. Spiders. And since we're talking about protection, so I could go to June, and let's say that I want to protect my spider portfolio from 287 down. I think it's going to go probably to let's just say 277. I want protection here to here, but I don't want to pay a lot of money. So I could do a 287, 277. Let's just say 280, 270, okay, something like that. I have to buy this. So I could pay about $240 roughly for this spread protection. Of course, versus buying, I could either buy the call for $600. I could buy a debit spread for $240. Or I do sometimes a butterfly, where you actually are doing that, but then also, wow, no, that's not right.
This one, yeah.
278, let's just say 270. So this costs even less money. So what I do is I'm actually like buying a put. So think about it. I'm buying a put spread on top, 288, 278, and I'm selling a put spread below it to help pay for this. So then it only costs me like $144. So
nice.
Anyway,
yeah,
so this is another way to do it. You buy now. This doesn't give you unlimited protection, but it gives you cheaper protection, and it gives you to points to where you're hopefully where you might be okay for that time frame. You want protection at certain points. So you just need to buy. You basically want a put spread here, and then you want to sell a put spread under it to pay for that. But of course, if it goes through all the strikes, it doesn't matter. But anyways, this is another way to do it, which I like to do. Is I like to do this. I do this on stocks all the time when they're falling, because now they get so expensive at the puts. For example, Nvidia has been falling, and I had to protect it, so I had to do some of these to protect the downside, because I didn't want to like pay too much for a protection. So I just started doing these. So for example, Nvidia was 172, or earlier it was 175. I did like 175. See, I didn't want to spend like $1,200 for a put, so I just do a butterfly, like 175, 165, 155. So then it became a lot more affordable. So this I paid only $120. I had protection from, it was above this, so this thing is already profitable. So it was from 175, I'm protected to 165. And let's look at the chart, see why I picked the levels. I wanted to protect all the way down to here, but I didn't want to pay that $1,200, so I did it this way. And naturally, it was a different price earlier. But so anyway, so I do these kind of things to pay for put protection without overpaying. And if I'm wrong, then this I only lose this. I don't lose all that put money, And sometimes I even do it where it's broken, where I'll even go lower on the lower strike and pay nothing or little money. sometimes I'll do it like this, where I protect to the areas I want, and I'll buy myself a wider put spread under it, capturing the higher premium and volatility and paying almost nothing for protection. And I'll sell calls above it to pay for this even and make a credit. So this is, how to be savvy.
Yeah. Yeah.
Okay. Any other questions on? Mm-hmm.
Question one on this. I generally also look at NQF for NDX. You can say NDX also, and then I monitor I have some indicators on those simply based on the EMAs.
NDX.
And then yeah, and I like to kind of. This is also for my hedging. This is my hedging for the hedging. That if I see in this one also my 40 EMA going down, the 120 EMA on monthly or 3 months, then I like to short. I short. This is one of the only, I think I will say, one of few stocks or indexes that I short. Otherwise, I don't short any. I don't do a lot of shorting. Just but this one I do.
Yeah.
But in this one, generally, how would you trade? Because this I use quite a lot for my hedging.
Okay. So I mean, how do you short it? You just go to the NDX and short it, or how do you short it?
Yeah, this one is as I said right now there is a NQF also that your mini that actually I have not tried, but on this NDX itself you can do that. Let's say if it is going. I don't know what your lines are. My lines I'm going to show that, as I said, 5 EMA, 20, 40, and 120.
Okay.
So based on that, wherever it is, and then I just short at certain price, whatever the price is.
Okay. Okay, using the moving averages, exponential. Okay.
Yes, that's all. I don't know.
Okay. So maybe later, if you put later on, just put a snapshot. I just want to see, on your chart or something later, to me or to the group or something. I just want to see. Where do you decide to sell?
Okay, actually, I have my chart right here only, on 3 months. If you're actually this one, on 3 months. Oops.
Yeah, sure.
3 months. Yeah. Just a sec. I'm opening my chart. So I have all these four lines, similar to your lines, the way you have on those ones. Same way, and when I see that they are going down, first is my indicator is that 5 EMA went down to 20 EMA, and then if 40 EMA also went down 120 EMA, they crossed crossover.
Yeah.
Went down.
Yeah.
That's where actually I say sure. But I have done it only a couple of times. And that also this is something I learned from somebody. Generally, I didn't, I just don't short TVX or VXX that I buy or sell sometimes, But this one I recently learned, so I have been thinking how other people might be using it. That's the reason I'm asking.
Yeah, sure. I mean, I don't, I do short, but I'll do short the QQQ or something because it's kind of similar to it. So I do short the QQQ. But I use more option strategies to short by selling call spreads and buying put spreads. I prefer that way because I don't want to have a lot of risk as well. The market continues to shoot higher, especially the NASDAQ is strong. It's the strongest index, I don't want to be, I want to be cautious. So I would, personally, I would sell call spreads and buy put spreads versus just shorting it personally. I do short here and there, but not for long, very short intraday. I don't like to leave short positions on overnight.
I do it.
Okay, good.
I kind of stop that. Actually, this is something I learned from one person who is into this, who is the investment banker. So the guy he was teaching me and then he said, okay, this is how I do it. And that's where
Yeah.
actually, okay, I learned. But I don't hold more than like 2-3 days because always I have seen that 5 EMA and 20 EMA lines reverse in that like 2-3 days.
Yeah.
So generally, like the market doesn't, unless we went into like 2008 times or 2000 times, those years. That is different.
Sure.
But otherwise, it's like 2-3 days. Yeah.
Yeah, and it's the fastest ones. Like back here, if you look at my chart on the left side, this is a 20 crossing over the 50, like here, back here. In October, obviously, it was a nice crossover, and you had a nice trend for a while until it crossed back over. So, it's a valid, it's your fastest ones. This is a good one, 20 and 50. When it trends, it does trend for a while, right? So naturally, if you were short in this, was great. And some of these people shorted as well, like this manager, is because they're also hedging their portfolio, so they don't mind shorting and leaving it because they're hedging a big portfolio or something, so they don't mind losing on this. They don't mind being wrong on this.
Yeah, exactly.
But for us small guys, we have to be careful because we'll get screwed.
I have to
if
be
this
careful.
thing starts.
That's why, like, I always, I like you said, I do put spreads, call spreads, and all that.
Good.
So another question is, what are these 4 lines in your chart? These
the red and blue those? Yeah, these are just simple moving average. The simple moving average is 20, 50, 100, 150, and 200. So I start from 20, and I want them to be stacking for a trending market. They should be stacked nicely. Where you have the 200, and basically, if they're stacking nicely like this, they're in a trend. When they're when they're crossing like that, you're in sideways chop, and that's when you want to be selling iron condors. This is when you want to be looking to sell put spreads below and call spreads above. So it just gives you a nice visualizing. And the 50 is a very important moving average because it always seems to bounce above it or below it. 50 is the one I like a lot as a barometer.
So you use SMA, not EMA?
Yeah, I just use simple moving average. Yeah, just I've done it. It may make a little bit of a difference, but I feel like more people use the simple one. I don't know, maybe I'm wrong, but I feel like more use that, so I just use that because I feel like people use the EMA also. And a lot of people use it as well, but I just feel like the old school guys still use the SMA, so I just kind of stick with that. But it makes a little difference, slight difference.
Okay. Yeah.
Okay. Cool.
Okay.
So I think good. So I think we covered all the main stuff was the put spreads, volatility products, a little bit on futures. I think that's it, right? Anybody else have any questions?
Hey Sandeep, when you look at the chart, how long the range you took for how many days you look for the chart? Like is it for 1 month, 6 months?
For a chart in general, I will look at a year to get the big picture. Give me any stock that we can look at. It just doesn't matter. I don't know, whatever.
SPY is fine. SPY is fine.
What was that? SPX or SPY? Fine?
SPY, yeah, SPY.
Okay, sure. So I like to look at it a year to kind of see the big picture. And then I'll generally, kind of be looking more interested in the 6 months. But I just like to have the big picture first because I want to see resistance points. So, I want to see where resistance has been, which is kind of like, here. Sorry, the last high. And what I'll do sometimes I'll look at the weekly to make it even cleaner. Let me delete the drawings now. So, I'll look at it a weekly, and that's where I kind of will get my line. So I'll kind of look at the resistance levels. I'm like, okay, this was a weekly resistance are very important because that's a longer term picture. So I see that resistance was here. I'll see kind of a channel. That's a little bit of art, just kind of seeing. I look at a channel that kind of was like this, that we've broken under, like this. And then I'll look at the short-term resistance, which is here. And then I go back to I won't do that one. So I'll look at short-term resistance, which is here now. And then I go back, I'll zoom it back to the daily and then make it a nice cleaner more accurate picture of what's going on. So obviously, S&P was in this uptrend. Now we've actually kind of broken the uptrend, which is kind of concerning. So anyway, but yeah, I look at a year for the big picture. I zoom out to the week. Once in a while, I'll even look at the month just to see. But the week gives me the best picture, and then I'll go to the daily. But yeah, 1 year, 9 months, because you want to look at the big picture, and then the last 3 to 6 months for the shorter term picture. And then if I'm day trading, obviously I go into the day time frame. But generally, I look at the daily charts. Even for day trading, I use daily charts because those are the points I want to be looking to buy. For example, if I'm day trading this, I'm looking at the 50 moving average at 285, and I wait for it to hit that level in the day. I set an alert, and that's where I would buy for a bounce because computer programs are picking the same thing up, and you get a bounce, or a short from that if I'm shorting or whatever. So I look at the daily charts even for intraday trading.
So how do we know like the 280 was the resistance?
Say that again?
So you said earlier like the resistance was 280, right?
Yeah. So, Mm-hmm. So let's
No,
go
the
back.
280, I think that's the lowest you can see the pullback means the down
down
trend.
here, 100. Okay, yeah, perfect. So let's go weekly again. So I look at here this week, and this was also a moving average, weekly, 20 weekly moving average. So I saw a lot of times it resisted here. It resisted, came back, resisted, came back, resisted, came back, resisted, boom, boom, boom. That finally broke above it. So usually in technical analysis, old resistance becomes new support. I'm going to go back to the daily. So this right here, boom, boom, was your resistance for a long time. And once it breaks above it, it's going to go up. It's going to check back, which it did exactly, which kind of made it even more valid that this is resistance and support. It came back, bounced right to that point, give or take, and back up again. So you would expect another bounce, even if it's a short bounce. If we do come back there, you would expect a little bounce, and then maybe it doesn't continue. But that's where we pick these points. Old resistance becomes new support. Okay? And if we had stayed above
that's for
this
like
level,
weekly, right? 20 weekly, you're saying?
yeah. Well, I mean, this is a daily chart now.
Right.
So for me, I do the weekly because I can make it so much nicer and I can see them cleaner because weekly resistance is more important, and that reflects the whole week, So then when you come out to the daily, it shows up on the daily as clean. It looks nice. It's exactly the same points, and then you can see it. For me, again, my preference, but it seems to work. And in addition to the moving averages, you just need more reference areas to trade against, especially when you're selling options. Like right now, we've got a resistance up here that's going to maybe have a hard time getting through, so you could sell call spreads up here on any little bounce and hopefully be okay. And then same thing on the downside, you could sell put spreads down here and hopefully be okay.
Hey, Sandeep.
Okay. Yes, sir.
Hey, the two vertical line or diagonal line are going up. Going back to the chart.
These right here.
No,
These right here. This channel.
What does the channel indicate?
The channel indicates where the price is going, at a particular time. Let me see is there any uptrending stock I could look at as well.
How did you draw the channel?
Let me look at. So yeah, you pick points, and sometimes you can do it on the weekly easier. Same thing. I pick out the channel line. I'll look where it hits the most lows. So I'll start it usually at the bottom, and it's a little bit of art, but I look at where it hits the most lows. 1, 2, 3, 4, 5, 6. The more lows it hits, the more valid it is. So this is 6 weeks that it hit the low, and then this creates where it just is parallel to it, and then I look for the top points. A little subjective, but again, like I said, I see 1, 2.
Sorry. Are you copying and pasting that line, or how are you doing the second line?
Yeah, they have it set up where it automatically will make it parallel. You just set it down.
So which study is that?
This is on the charts, and it's also on the regular. when you on your Thinkorswim,
Right.
it's also
Which drawing tool are you using when you're drawing those channels?
okay. So it's right here. They'll have here at the bottom, and you're going to pick the channel.
Oh.
And then you're going to do you see right there? Yeah.
Yep.
And then you just draw it there, and then click, and it's going to create the second one where you can put it down where you want. Like that.
So if you look at going back to Apple.
Okay, yeah, sorry. So yeah, I look at the most points. Let me just do it. Because yeah, some people have a hard time doing it, but once you do it, it's so much fun. So you want to hit the most points on the top, and some are going to protrude through it because, but you want to hit the most points like that, and then I go back to the daily, and it's cleaner. I mean, you can see it so much better. It's more valid, and you can see how much it respects it. How much it respects it, right?
Yeah. So basically, that channel is telling you that it's going towards 30.
What was the last thing you said? It's going toward what?
Like $230.
Yeah, I mean, you see, what I can do is extend channel, extend. Okay, boom. So yeah, I mean, this tells you that this stock is in an uptrend. This channel tells you, first of all, that it's an uptrend, and that it goes to the top, and that's where the resistance seems to come in. Then it gives back, goes back, gives back, and right now, yeah, this target would be, around 230, which is the old highs.
So
the long-term target. Mm-hmm.
You can anticipate, and then maybe like 6-8 months down the road, or even a year from now, buy those 230 calls.
You could do that. Yeah, I mean, you could if you're bullish on the stock, and the only time it's not going to. This is valid until it's not. Like the only time, if and when Apple breaks this bottom of this trend line, then this channel is maybe not valid anymore until it comes back into it. But if it just drops out for some reason, then you're wrong. But at this moment in time, the odds favor this going up to 230, back to its old highs, assuming the market stays intact and there's no other news. But yeah, you could buy calls if you like, especially now that it's pulled back, is your opportunity to buy calls cheaper. So yeah, this is if you want to get long. I started selling put spreads today on it down here, just to get some long delta, and I use that money to buy some call spreads above it, just to kind of like go ahead and line up for it. But yeah, this is an uptrend, and you're not at all-time highs, so your resistance coming up is going to be, the next point of resistance is going to be right here, 220-ish. That's where there's a lot of people here that bought that want their money back, and they're just waiting for it to get here to sell. So first target would be 220.
So that's
why what's that?
So that's the justification is we're looking at that 230, 220 resistance is those folks who bought it at that level or haven't let go the stock yet, so they're still holding on to that.
Yep. And that's why this stuff works. Mm-hmm.
So then if it gets to that level, there's going to be a big short.
There's a lot of stops right here. There's a lot. All these people have probably put their good to cancel orders here. They sat from 220 all the way down to 145 and are like, God damn, give me my money back. And as soon as it gets through all this, some will hold on, but many will tire and say, just give me my capital back. I'm moving on. So that's why all those stops are up here. And also there's also a lot of long-term shorts that are in here that are like, no, I'm still short the stock, and then their buy stops are up here. That's when they're wrong, They want to get out too, because they're like, okay, well, this thing didn't work. Or they've already taken some money and they've left some on short, and they've also got stops here. So they've got buy stops here. These guys have sell stops here. So a lot of there would be some resistance here, in theory.
Right.
That's your first target.
Right.
Mm-hmm.
And then,
I'm
just trying to learn how to read charts. So, and when you see a gap in data on a downtrend, I think you guys call it when they gap down or gap up.
Yes.
What does that mean?
This was an example. the price on this day was here, and the next day it opened down here. So there's a gap. There's a price void between here and here, right?
Right.
And what happens is a lot of times, and it's pretty amazing, stocks like to fill gaps. So look what happened here. It took a little few days, but then what happened? Once it got through here, it filled this gap, and then that's it. Then it turned back around. It's like it had to just fill that just to touch it, and boom, back down. So there's gaps that do get filled, and sometimes they don't. Like this one, there's an up gap that hasn't got filled. Maybe at one day it will, but for now it's not filled. So not all gaps fill, but many gaps do fill. Like even here, there's a small gap here. Look at that, it gapped up, and what happened? Boom, fill that gap back, then continues. For some reason,
what's the reason for it?
Gaps are. I guess there's I have to think about that. It's probably there's people here who are. I have to think about that. There's a reason, I'm sure. I haven't really thought about it, and maybe somebody else can think about it. Just some reason they just do.
So that's what's called
I know.
a gap up.
Yeah, gap. If a gap down, it's gap down. If it's a gap up, it's a gap up. And a lot of times there's stops there. That's one reason it fills a gap. Like for example, that's one reason. So for example, people start getting short this Apple, for example, and it starts going down. Now they set their buy stops right up here, right above this, because if it goes back above through that, then they're wrong and they have to buy to cover. So that I think that those buy stops set there cause it to just go up and fill the gap, and then it just goes back. Then the buyers run out. So I think it's a stop. Mm-hmm.
Okay.
Mm-hmm. Yeah, gap down, gap up, and then and in the mornings there's generally gaps. Like today, Apple, for example, like yesterday, for example, Apple had a gap, and then what did it do? It started filling that gap, and those are great morning trades. Today, it's technically, this is 5 minutes, right? Yeah, perfect. So technically, I look at the first 5-minute bar, and once it breaks through it, then you can fill the gap. But if it never breaks through it, it generally is not going to do it. So here, you could have set a buy stop above it. It never would have filled. But yesterday, you could have set a buy stop above the first 5-minute high right here. Mm-hmm. And it did. And you got, a couple of points out of it. And things will do that. They'll gap down, and then they'll fill a part of the gap, not all the gap. They'll part of it. You can get like half the gap sometimes. You just. Mm-hmm.
But that marker where there's a gap down, if you zoom in, is that like a weekend after or the day after opening?
So it depends on what you're like. If I'm looking at a daily chart, it would show here. But if it would show like this was a 5-minute chart. It would show.
Going back to the previous one you had.
Here. Mm-hmm.
Yeah. Now if you just zoom in.
Yeah. Yep. Oh, sorry. Yeah. Uh-huh.
If you just drag and create a square, it'll zoom in. Yeah. There you go. So that's that gap right there. Is that a closing on one day at the high around 211, 212, and then the next day opening?
Yep. Yeah. So there's no overnight action showing here. So basically, this was the close at night, and this was the open at the bottom.
Right. So then
open here.
Right. So when you're looking at a chart, and if you see that, you can try and make some money from that 204 level all the way up to 207.
Exactly, and that's what a lot of people do. That's why the first 5-15 minutes are so busy, because there's a lot of that going on. They're fading the gap. So I'm going to look at it on the Apple or Netflix. I think did it fade today? Yeah, so I think that, let me get rid of the overnight. So I'm going to zoom. So let's look at yesterday. So it wasn't a lot of money, but some. So here, yesterday, closed the night before, gap down. This first 5-minute bar is formed, and you would set a Sorry, just trying to see his China news. Okay, so you would set a buy stop right here. Now buy stops are only filled if it goes through it. So it would have filled it here at 379.29, and then you had the potential for maybe at least a point. From that point you just had to sit through some junk, and then it did go up. So yeah, you'll get a lot of times a quick, or for those scalpers you can get like a few cents sometimes, just quick, just boom, 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 just get it and get out. So yeah, you'll get like some fill the gap, unless it's just the market is just tanking. Then it's another story. Like today, I don't think a lot of gaps would have filled.
Yeah, yeah, that makes sense. So I always wondered about the gap up and gap down, and then I don't know exactly what is the statistics on the fact that any stock that has a gap up and gap down, does it ever fill? I'm sure there is. I'm sure there is statistics behind it.
Sure. Yeah, probably is. Absolutely. Yeah. But yeah, if you ever hear somebody say, I'm fading the gap, that means if it's a down gap, I'm going long, or vice versa. Sometimes things gap up after earnings, especially, and then people fade them. People fade them down, like Facebook, I think was one. Did they fade eventually?
But
they'll fade
it. If it's a gap down, then or even a gap up, it's also a good one to do a weekly call or a weekly put.
Buy a put, you mean?
I mean, yeah, if it's a gap down, you can buy a quick put and make some money.
Well, if it's a gap down, you would want to be playing it up, right? So you would buy a call.
That's what I mean. Yeah.
Exactly. Yeah, exactly. Yeah, you could just buy a call. Yeah, exactly. You could just buy a call real quick, and just try to get make a little money and get out. Don't be greedy.
Right.
It's always quick. It's quick. You just got to get it and get out quick, and just not be greedy. Like this was so you can see they always try to fill those gaps and then they collapse.
Yeah, so that gap fill would have been good for a good call option.
Absolutely. I mean, it doesn't matter what you use, whether you buy the stock or buy a call. It's the same thing. It's your choice. It's like, what weapon do you want to use?
Right.
It's the same thing. And sometimes I just do the stock is just really quick in and out, and I can it's easier for me to set a buy stop with stock. That's why I do stock for these morning quick trades, because I don't have time to go look and figure out the option chain and this and that. I just let me just show you the example of whatever. But anyway, I just put a buy stop in. For example, this is the futures. If I wanted to set a buy stop, I'm like, you know what? I want this stock, if it breaks above this level, 26.028, so I'll go put a buy stop right here. I'll buy stop. I'll say send the order. Boom. Buy stop is there. What is this order going to get filled automatically? No. It's only going to get filled when it penetrates. Let's say this was the top of the 5-minute bar, first 5-minute bar, right? Let's say this was the high. I would set the buy stop right there, so that way it has to go through it with momentum, hopefully. Now, of course, it can fail, but still, I want it to go in my direction to get filled. And if this thing goes here, collapses, no problem. I never got filled. No harm, no foul. That's why I love buy stops, and that's why you stock. It's easier to do that with for quick. But you can simply go buy a call, exactly. If you really like, okay, I just want to get in the call because I think it's going to break the top, done.
But
you're on the downside.
You're doing a buy stop, a higher value, higher price point compared to where the stock is.
Yeah, I'm not trying to guess. Like you never know if the stock's going to go up and down. I want the stock to prove itself and go in my direction. Now it sounds dumb and counterintuitive because you're like, why are you paying more money if you're going to go long? Well, I don't know if I want to be long it. I want it to prove and go in my direction. So it's kind of counterintuitive, but at the same time, it saved me from so many trades that I would have got sucked in because I think, oh my God, this thing has great earnings. This thing's going to go flying. I buy it, boom, boom. And what do you know? All the sellers come in and take the garbage down,
Yeah.
But if I have a buy stop.
Yeah, that happens.
Yeah. It makes sense.
Yeah, it happened today also, actually, like on the NVTS stock.
Yeah, sure. Yeah, it could have got you. Apple got me like that, because I just got in because I was like, oh, this thing is going up, and the next thing you know, I didn't do my buy stop today. I was like, you know what, this thing is going up. I love Apple, and I didn't mind owning it at the same time because I was like, it's got a dividend coming in a few days. So, but whatever, that shouldn't be the reason. But anyway, if I had honored my, if I look at Apple, and if I had honored my buy stop, let me look at it, 5-minute chart.
Could you just clarify, what do you mean by buy stop? I'm just trying to understand your jargon.
Okay.
Buy stop.
Sure.
What do you mean, a stop loss, stop limit order?
No.
What are you saying?
Yeah, it's almost like a stop limit. So, well,
Take a look at Sandeep.
Oh. Yes, sir?
I was actually looking at one today in that same concept. Take a look at JMIA.
Okay, I'm going to go to that 1 second. I'm going to just show you. So, like, look at this right here. This was Apple, the first 5-minute bar right here, okay? Right here, right? So, when it opened here, I just was like, this thing is, started shooting up here. I bought them here. Now, I did take a little bit off, but then I left it on. Now, but I was wrong because, I had, overall, the thing fell, right? So, now what do I mean by a buy stop? So, the high of this bar, let's see, how can I see what the high was? The high of this bar is right here. You see right here, 207, it says it right here, 207.42, okay? So,
yeah,
the right way to trade, okay? So this gap down from the previous day. So the yesterday's close was higher. So we got a gap down. So I want to be long it, but I don't want to just get in long because I would have been wrong. So what I do is I look at the high, first 5 minutes, 207.42. I don't want to get into this until it breaks this. This is like a short-term resistance, so to speak. I want it to break through that. And I don't want to be long until it proves itself. So 207.42, I would go, I don't have any stock, let's say. I would go and put a few cents above that, 207.45. Okay, so it's almost like a buy limit. 207.45, I would go into whatever it is. Let's just say whatever it is. Okay, 207.45, I would say buy whatever.
45, yeah.
It was 42, so I just go a few cents above it because I want to make sure it goes through it. I don't want it to just touch that point and come back. I want it to break through it. So I would just buy 30 Apple stop to open, and I would send the order. So then that order is right here. And if this stock never goes up there and plays around, hits here, comes down, I never get filled. Only time it gets filled is if it breaks through that, boom, I'm filled at a point around here, and then it continues hopefully, and then I can work with it. So it's just like a stop limit, but I don't want it. I'm not just buying it. I'm not trying to say I want to buy now. I don't want to buy for the best price. I want it to go in my direction, and I do that in futures all the time because they're great for that. Because
now I'm understanding like your thought process. Okay.
Well, you also want the stock to prove the volume too, right? You want an uptrend with a good volume, knowing that this is going to go in my direction.
Yeah,
exactly,
that's another reason.
Exactly.
If there's volume behind it, it's going to push through it. And there's two reasons. There's also stops set up above that first 5-minute bar. There's people who have shorted that thing at the first right away, and they also put a stop above that. So that's another reason it works. They've got stops above that point, and once their stops get hit, it pushes all these buy orders in, pushes it for a little bit. Gives you a few point or whatever. You know what I mean? So you got stops there.
So you are looking at the OBV or maybe some other volume indicator that it is coming, but still you don't want to buy at that price. You want to buy a little bit out of the money, a little bit some cents, just to see if it is moving in your direction. Volume is going up, then it will go further up, and then it will sell. That's your idea here, right?
That's the thought process.
Wow.
Yes. That I want momentum on my side, and I don't want to get caught up in a trade that's not going in my direction because I just feel like it's going. I don't want to go on feeling. This is a lot about feeling, but you have to make it as objective as possible. So how can I make it objective? This is how you do it. Got it?
That's interesting. That's pretty interesting. I wish I would have done that. In my NVTD, I bought some shares. Half I sold in profit, half I kept, and today it tanked almost $4 or $5. Now I'm stuck with it. But if I would have followed this approach, maybe I would have not.
Yeah. So it's not foolproof. and you have to be diligent to take your profits. You can't just like once you start making the profits, take some off or put your then you move the stops under it too. The same thing, you move your stops under it, follow it, follow it with your stops, so that way you don't get stuck with the stop. Last thing you want to do is get stuck with the stop. You just follow it, and until it takes you out and get out of the way and just move on, because these garbages will turn around on you.
Lately I have been thinking, like, I experimented with a couple of the stocks that what I do is, like, I'm putting stop loss also. Like, if I want to buy, like, some shares, I buy, let's say, 200 of those shares with an intent that 100 I will sell at very much profit. And then after that 100, I put stop loss, whatever profit I had, minus for that from the strike price, half of that minus from strike price, and that's where I put stop loss. Good until cancel. Okay. But actually in my platform, the problem is, like, during extended hours, the stop loss doesn't get executed. It doesn't execute the stop loss. So on your platform, does it work? Like extended hours honor the stop loss?
Manish, do you know? Because I never.
What was the question?
Do your stop losses ever get hit, like pre-market?
If you have to put the order in with the, we have to put the order in as a plus EXT, the extended hours.
Okay, then, but otherwise it won't, right? What about good to close?
What actually I'm saying, Manish, I put it extended hours, but I don't know how your platform, but in my platform, I can put only limit order, and I cannot put, stop loss or stop limit on that.
Oh, but that might be limitation. There might be limitation.
Okay. Even if I pick, like for example, like, on the one stock I had, stop loss good until cancel, because I made some money on those. Then half of my profit, I subtract that from the current price, and that's where I put my stop loss, right? And I look at chart also, but that's my general thumb of rule. But what happens is, if it is on daytime, it trades, but on extended somehow, I don't know why.
So maybe stop loss and buy stops are not allowed after hours.
Yeah, but at least in my platform it is not, or for me it is not. I have to talk to them.
I would assume if it's not allowed, it's not allowed anywhere.
Mm-hmm. I'm not. Okay.
Because
I'm not sure. But
some brokers allow it, some brokers does not actually. But again, there is no guarantee that the price will be sold. Sometimes, in the pre-market and the aftermarket, price seems the bid and ask price is very large and keeps sometimes it breaches through and you won't get sold. So you should be lucky to get that whether your order gets sold at that high. But in the regular market hours, there is a higher possibility that you will be sold, but in the pre-market or aftermarket.
I wouldn't think it would be platform dependent, because that way they will lose a lot of money. They will lose customers.
Yeah.
If it's not allowed on, like, for example, Thinkorswim, then chances are it's probably not allowed anywhere. Otherwise, people would jump ship and go to Fidelity or Schwab or whatnot.
Okay.
Yeah, I know Fidelity towards that.
It's probably not allowed after hours. Certain types of orders are probably not allowed after hours.
I'm gonna talk to that, then let's see. But that's what I was saying. So in your case, when you are putting all this buy stop, sell stop, so these work even on extended hours?
Well, not for stocks, for futures, but not for stocks. They only work during day hours. Let me think. For extended hours, I can do limit only. I don't think you can do buy. Yeah, you can only do limit orders extended.
You can try one now, so let's see if it lets you.
Well, it won't matter. They're not trading now, so. But I'm saying I could set it for tomorrow, but it won't let me. It won't matter. I could put an order in right now for tomorrow, but it's not going to do anything till tomorrow.
Right.
But extended hours, generally I think they only let you do limit orders. You can't do, I think so. I don't think you can do buy stocks. I think I've tried that before after hours on earnings.
Yeah.
You can't do buy.
For me, it is not letting it.
Yeah. I'm pretty sure
Yeah.
is limit.
Buy stop loss, those have to be during hours.
Yeah.
Yeah, I think so. Yep, I think it's same for this too. Yep. So, okay.
All right, well,
All right, cool.
11:30, I'm not sure if he's going to kick us out or whatnot, but we can set up another one in a couple of weeks or next week.
Okay. Yeah, sounds good. Sorry, Thiru, I thought you were not even here. Was there any other hedging strategies or anything you would suggest to us or anything?
I don't know.
For like protecting
same thing
portfolios?
yeah, same thing, but yeah, put, right? So it's for a kind of long-term or swing portfolio. I mean, so what I'm doing is buy a put, right? SPI put, so which is similar to setting up a synthetic long position. But what you do is like, so one SPY put is currently at now 290 or 280, right? So it should typically cover 28,000. So when I'm setting that portfolio, right, so I take a look at it and see how do I, when I invest around 25K, so how do I protect it, right? So you buy it with the put. So I kind of spend for 25K around $400 to $500, kind of scan through those option chain to see how far, the sensitivity is kind of way, right? So you may not, but in a regular bull market, you may even get 4 or 5 months of coverage. But right now, I was able to get up to, with that 2%, I was able to get 1.5 to 2 months of coverage after all these last December and all these sell-offs and things like that. So what I do is I kind of do that, and although it's although my portfolio is protected at that level, so when, let's say, a stock market pumped 6% or 5%, right? So at that stage, your whole portfolio raised by 6%, and your put is almost at almost close to, you might probably only 10% or 20% of the premium is left. At that point, kind of add another put. So typically, if you're just using some portion of your gains and adding in another put, right? So if the gains are not that much, but if you still want to put, what I do is from the point that I had the initial put, I buy a put spread. So by that way, I'm protecting my initial capital, and also I'm protecting the gains, right? So keep going. So in this volatility market, I'm actually trying to overprotect. So when you need, say, only 3 SPI puts to protect your portfolio, I can imbalance it by adding 5. But whenever something drops, I kind of sell. So the goal is to buy put when it is rising, and goal is to sell puts when it is dropping, right? So you could even sell at a different expiry to make it a calendar spread, but you actually do that at different time spots. So rather than you buy a full put spread, it is actually more efficient to buy a put on the way up and then sell a put on the way down. So, right, these are the things where I do. And also, so since it's almost 2%, and then you buy another put, probably you're actually overputting. So I do follow some short-term things like, so for call spread, I don't do SPY, I directly go to SPX. So the reason why I do is, like, especially when Trump announces and you're very sure that something happened to the market, and in the next 2 or 3 days, I go there. So at that time, I go to SPX and sell a call spread to cover the premiums that I paid on the put, right? So the stocks that you purchase are either are on your portfolio. Try not to it's not, you shouldn't manage it. I mean, for each and every volatility, I don't really do that. So only mainly because I don't have much time to manage each and every stock. So I kind of have 30 stocks that's already been sold. I mean, going each and every through on a daily basis is going to be crazy. So all I do is kind of look at the market, where it is going, and then short-term fluctuations, try to do that put, buy, put, sell, and things which automatically adjust your portfolio. So one thing happened recently. I mean, you might have seen all the sectors were green, and healthcare is the only one that is dropping. So I remember that a couple of weeks ago that happened. So, right. So when your portfolio is filled with stocks with all kind of sectors, and you might be wondering certain times, like your stocks on that particular sector keeps going down, but overall, so there is something. So at that time, you judge your portfolio to see where exactly and what is happening, and then you make some corrective actions. There, you kind of go into that particular sector, and then either buy a put or something to hedge further losses and things. So by that way, do that. So hedging has different things, right? One, the known hedges, right? So market you're expecting you will have pullback something. So that is a known case. So you kind of hedge it. So earnings you expect on a particular day, that particular stock is going to do. So it's all. So you kind of tend to do some certain things before the earnings to hedge that particular stock. And if one particular sector is going, you hedge that sector on that specifically, right? So kind of do that. Unknown things we cannot control, you react after that, but anything known. So you won't, I won't, I mean, whenever I set up portfolio and living overnight and probably thinking of keeping it for months, and so I always try to keep one puts so that it covers covers your ass on a down days trade or something, right? So you do that. Right. So another thing is like, I mean, either you keep adding puts. Another thing is I roll up too. So let's say you bought a 5 put 2 months ago for something, so the May expiry, which is going to pretty much you're talking about 10. So and let's assume it has only, say, out of the $400 or $500, only $100 left. I mean, so you may take a look at that and see what to be done. Is the market is going to keep going up, or this 10 days something going to go? I mean, I try to bring my put close to the money. So use the remaining money and buy another put a couple of months away there. So all we are talking about is you're having 98% of your portfolio in stocks, right? And investing 2%. Probably, I mean, when you're overprotecting, you'll add another thing, so 2, 4, or 5%. So when your stock market goes like what it did in the last few months, like 20% up, right? So 5% is something that you invested, but that is going to go away, but you'll still have the 15%. And when a day is like down days, when you sell it, you can easily cover back the premiums that you invested through other means. So you always kind of try to stay green and go along with the market and slightly beat the market. So so that's the goal. I mean, you are not expecting something this year. You're not expecting something overnight to make a lot of money or something, but you will be pretty much going along with the market. If market rates 20%, and your portfolio would be slightly higher if you properly hedge it, and I mean, if you cover the premium cost in different ways, like different pullbacks, and as I said, like selling the put and stuff, you will always have an edge. And also, if you cherry pick the stocks properly, it will also have an edge than the actual market. So I try to my goal is always first goal is not to lose the capital that I put. And the second goal is to at least stay above the market a little bit, wherever it is. So that is my benchmark to see if not, and something is going on with your portfolio, and then find out the law and act accordingly. Right. So for beginners who never done that, I just found a link which is pretty close, not exactly, but they explained the strategy very clearly. Let me put that link in the chat. Right. So, read through it. I'll show you what can I share? Will I be able to share? It's just for 2 minutes. I know.
Yeah, sure.
All right, so I'll put this in the chat as well.
Yeah.
Right, so what I am talking about is, how do I do that? Share content, is that the one?
Yeah, hang on. It'll get to you.
It says download something.
No, you're the presenter now. If you want to share.
I don't know. I have to add to something to Chrome.
You just go to the menu and say share.
Oh, yeah.
Yep.
Right?
Yep.
Yeah, it's the same link, right? So, read through this whole article. Let me show what I am. Calculate contracts to hedge, right? So this uses an example of SPX, long time ago, not the current value. So the whole point, let's say you don't do anything, it's purely passive. So you created a portfolio worth of, say, 50,000 with a cost of hedging. And let's say if the market raised by 10%, and let's assume the 10%, the 10,000, if you would do, it's just a 2% of it, right? So you would have gained only 8%, but you lost that, whatever the hedging. But how it works is like when stock goes minus 10%, you won't lose 10% of your portfolio, you would have lost only 2%, right? So that's the goal. So it's like the same synthetically long position. So your main loss is kind of, because it's not exactly the same when you have stock positions, it will be slightly up and down, but you get the point, right? So it's like your stop loss is matched. It won't go back, but when the gains are, you'll be able to gain. Only that what you lose is 10,000. But if you do a little more, not just stay passive, if you try to recover this hedging cost, or do some more extra actions, you'll always stay positive no matter where the market goes up or down, right? So I also do one more thing. I go to my portfolio. I don't know whether you guys know about stress test and value at risk. There are two things that you can on a portfolio you can. So where is a measure? So I'm pretty sure that you guys will be, every broker will have that report, at least in interactive brokers, it does have it. So what it does is like, on your portfolio setup, so how much you're really risking is something that it will calculate. I keep a tab at that every now and then to make sure that my portfolio is kind of always not high risk. So you're putting some 25,000, let's say 25,000, right? So we don't want to be at a loss when sell-off happens. So there is always some amount is what is risk. So that this particular factor gives. Another thing is like stress test, which is like your profile tool. So it will do at the whole portfolio level, not at the particular stock performance profile or something. So another not portfolio stress test. Right? So there are two reports that you should be able to look at. So what this does is like, again, if you run that report, it will run multiple scenarios.
Sorry, actually, I have to just drop because I'm feeling sleepy. Tomorrow morning, I have to get up. I have like 8 o'clock call. Maybe like, I will, yeah.
Sure.
I'll catch up later. Thanks a lot, guys.
Yeah.
Really appreciate
Good night.
it. Manish, everybody, yeah.